Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will explain what a credit score is and how it is used as a starting point when applying for a mortgage. Also, stay tuned at the end to hear one of Tyler's dad jokes.
While it is true that having a high credit score is a good thing overall, there is a common misconception that a higher credit score will always get you a better mortgage rate. The fact is that for many prime lenders, especially for an insured or insurable mortgage, a client with a 600 credit score would get the same rate as someone with a 900 credit score if they were approved for the mortgage. Credit scores actually matter more when dealing with alternative or B lenders, since many of these lenders offer tiered rates based on credit score. The majority of prime or A lenders have one rate for each mortgage product. While the credit score is always important and there is a minimum threshold, more emphasis is placed on the story of the client's credit and explanation of what is found in the credit report. It is definitely possible that a client with a 650 score could get approved by a lender who may decline someone with a 750 score since the details always matter. It may be that the client with the lower score has long-standing accounts that are always paid on time, but they may have too much credit available to them, and this is causing the lower score versus the higher score client who has one loan or credit card that is fairly new and doesn't show much history of handling their credit profile. Lenders want to know that you are a good candidate for them to lend their money to and need to be confident that you will honor your responsibility and make your payments on time. A strong history of doing so is more important than the score by itself. The first C of the 5 C's of credit is character, and this refers to your credit history or how you have managed debt in the past. In the example above, Client 1 shows good credit history, while Client 2 hasn't had enough credit history to establish this part of what lenders look for. Let's explain what a credit score actually is. Your credit score is a number between 300 and 900 that is generated by 2 credit reporting agencies here in Canada, Equifax and TransUnion. The credit score makes up part of your credit bureau, which is a report that is requested with your consent and generated when you apply for credit. Many lenders also report back to the credit reporting agencies with your payment history on loans owed to them, which is used to keep your credit report dynamic and always changing over time. All the incoming and outgoing information regarding your payment history, the types of credit, and available credit is then translated into your credit score, which is a quick summary in number format of your credit profile. A credit score above 700 is a good indication that you handle credit well, and a lender would feel comfortable lending you money. However, as mentioned before, the details of what actually makes up the score itself will always be reviewed and mitigated to ensure the score is an accurate reflection of your credit history. A credit score below 600 may indicate that you have had significant credit issues in the past and may present a challenge in having a lender approve you for a mortgage, since they may be hesitant to take on the risk of lending you money. I mentioned earlier that character is the first C of the 5 C's of credit. The others are capacity, which is your ability to repay your loans. Lenders will compare your current and potential liabilities with your income and ensure that you can handle all the payments. The next C would be capital, and when applying for a mortgage, this would represent your down payment and reflects the level of risk you have in the agreement. Collateral would be the next, and this is what is securing the loan. In the case of a mortgage, this would be the property itself, which is also considered and mitigated by the lender before approving the mortgage. Finally, we have conditions, which displays what the money is being used for. When purchasing a property, it is clear that the mortgage is being used to complete the sale. But in the case of a refinance where a client is looking to take equity out of the property, the lender reviews what the money is going to be used for and bases their decision on this as well. A refinance where the money will be used to renovate or put a child through school would be looked at more favorably than a refinance where the client is feeling lucky and wants to try their hand at the stock market. In conclusion, even though a high credit score is important, for many mortgage applications, the score itself does not affect the interest rate you will be offered by a lender. Lenders look at the credit score and then review everything that makes up the score itself, while also weighing the 5 C's of credit in order to make their decision of whether to approve you for a mortgage or not.
In today's episode, we explained how your credit score is used by mortgage lenders when you apply for a mortgage. Thank you for tuning in to Mortgage Foundations, and remember, every home starts with a foundation. Your mortgage should too.
Time for this week's dad joke, which I may have used once or a few hundred times myself. I have no idea why my credit card keeps getting declined. Every time I check my account online, it says I have an outstanding balance.